President of the Nigerian Economic Society, Professor Adeola Adenikiju, Vice President Dr. Baba Yusuf Musa, Vice President, our very own former Stella Madueme, National Secretary Dr. Frank Wede, members of the Nigerian Economic Society, Excellencies, ladies and gentlemen, thank you for the immense honor of inviting me to deliver this address. Speaking to you is a homecoming for me in more ways than one. Although my schedule this week prevented me from coming home to join you in Abuja today, I feel present with you in spirit. But the connections go far beyond that. My father, the late Obi Professor Ngozi Okonjo, was a proud member of this society. After finishing his mathematical economics PhD in West Germany in the early 1960s, he came home to teach, first at Ibadan, University of Ibadan, and then at the University of Nigeria in Nsukka. In early editions of the Society's Nigerian Journal of Economic and Social Studies, he published papers on issues such as population growth patterns and how our newly independent country could train the economists it needed. Several years ago, I was proud and humbled to be named an honorary member of the Nigerian Economic Society. Because of the links to my father, of course, but more importantly, because improving economic prospects for all Nigerians has been one of the central preoccupations of my adult life, a preoccupation that I share with each of you. For nearly 70 years, the Nigerian Economic Society has earned its place as one of our country's most respected professional bodies by working to advance better teaching, analysis, and policy making for the benefit of people across Nigeria and the wider continent. Good data and good economic analysis is a prerequisite for appropriate policy making, something not always appreciated in our economies. Today, as we rethink development prospects and trajectories for Africa as a whole, and Nigeria in particular, we have to grapple with the dramatic ongoing changes in the world economy and in the global political landscape. That's why I want to talk to you in this keynote about rethinking Africa's development. Global trade and trade policy are facing the biggest disruptions in the past 80 years. The United States is turning away from the international economic architecture it did so much to create. Meanwhile, development aid, at least as we knew it, is over. It's not just the US cutting back. Leading traditional donors have slashed support and are diverting funds to other priorities, from refugee resettlement to rearmament. The writing had been on the wall even before this year. According to the OECD's Development Assistance Committee, global aid flows fell by 7% in real terms already in 2024, while Africa's share of ODA from traditional donors had dropped by 11 percentage points over the preceding decade. These changes stand to have a major impact on poor countries, deepening their vulnerability to climate risks and future economic shocks. At the WTO, we have been following trade policy developments very closely. Our latest estimates suggest that global goods trade volumes will grow by 0.9% in 2025, well below the 2.7% growth we had expected prior to the US tariff actions. One thing that might surprise you, though, is that our economists project that the reciprocal tariffs introduced by the US will have a minimal impact on Africa's trade and GDP. On this issue, let me be the usual two-handed economist. On the one hand, there is good news. Africa's limited trade with the US, only 6% of our exports and 4% of our imports, is insulating us from the current disruptions. On the other hand, this isn't actually good news. It's a function of the continent's lack of integration into global markets. Except for a handful of countries, including Lesotho and Côte d'Ivoire, and tariff-exempt raw materials like oil, the continent is just not that exposed to the US market, as I said, and hence to US trade policy. We have just not been able to make as good use of the AGOA trade preferences as we should have. The continent as a whole accounts for less than 3% of global goods trade, and an even lower share of services trade. Nigeria accounted for just 0.23% of global goods trade last year. To deliver on the development needs and aspirations of people in Nigeria and across Africa, this needs to change. Africa needs to move from the margins to the mainstream of global trade and investment, and Nigeria has important potential to do so. Though it may sound counterintuitive amidst all the talk of geopolitical stresses and protectionism, I will be arguing today that the current ructions in world trade offer a window of opportunity for the continent. Just a few facts to help us see the opportunities. Remember that the US, despite all the noise, accounts for about 13% of world trade. South-South trade accounts for close to 25% of world trade, up from less than a tenth 30 years ago, so really moving. Much of the rest of the world continues to trade on more or less normal terms, in spite of the tariffs. Roughly 72% of global goods trade is still operating on basic WTO most favored nation tariff terms, the rates that each member extends to others on a non-discriminatory basis. This provides a stable core to the trading system within the ongoing instability and uncertainty. The overwhelming majority of WTO members say they want to preserve and strengthen open and predictable trade. The push by many countries and companies to reduce risks by diversifying away from over-reliance on China creates opportunities for Africa to attract labor-intensive manufacturing. As the economist Justin Youthful notes, activities like textile production have always moved as countries grow richer and move up the value chain. There is no reason that these flying geese should only go to Southeast Asia. Re-globalization, as we call it, decentralizing value chains, can bring some of the geese to Africa. To seize the opportunities at hand, however, we first need to change how we and how the world see us and talk about African economies. For too long, the narrative around Africa has been centered around our deficiencies. What we lack, what we need, how the rest of the world might provide it. For a good part of my career, I was part of the aid community and saw no harm in Africa accepting loans and grants from multilateral development banks and other sources, as other continents had done before us. I still don't. After all, Africa has been a source of aid to the growth of Europe and the US, based on the extraction of our natural and human resources. What I do mind and do not agree with, though, is that over time, the narrative has become one of Africa as a supplicant for aid, not as a candidate for investment. This has become damaging to our prospects. It has obscured our strengths as the world's workforce and market of the future, a prospective driver of global growth, not just a passenger hoping to catch a ride. To borrow a phrase from Chinua Achebe, if you don't like someone's story about you, write your own. Today we have no choice but to write our own and to rethink economic models, reform policies, and reframe the continent's future around trade and investment. And that's what I'm really going to talk about. Let me take a moment here to make clear that I'm not at all dismissing aid as unnecessary. It's both necessary and plainly in the self-interest of potential donors to fund global public goods like climate adaptation and mitigation, or pandemic preparedness and other public health priorities. But aid alone was never going to get us to where we need to go. UNECA, the United Nations Economic Commission for Africa, estimates a $1.3 trillion annual investment gap for Africa to meet the Sustainable Development Goals. Compare that to the $212 billion in global ODA spending last year. One budgeting approach governments might consider is something we did here when I was Minister of Finance. We kept aid below the line and determined budgetary trade-offs based on our own revenue. On the side, we made plans for where aid could be spent if it actually materialized. So as we rewrite the stories we tell ourselves and the world, One really exciting thing is that Africa has some of what the rest of the world wants and lacks. Let's consider three aspects of this. First, on an aging planet, Africa's young populations represent the workforce, skill base, and markets of the future if we provide the right training. The UN projects that the continent's population will reach 2.5 billion by 2050, over a quarter of the world total. Between now and then, sub-Saharan Africa's working age population is set to grow, while those in East Asia and Europe shrink. By mid-century, the region will be home to the world's largest pool of workers, 22% of the world's working age population, up from 13% today. The continent's young, increasingly educated, tech-savvy workforce will be an opportunity for Africa and for the world. Unifying markets through the African Continental Free Trade Area will make the continent even more attractive to investors. Second, Africa has the arable land the world needs. According to the UN Food and Agriculture Organization, the continent possesses 2/3 of the world's uncultivated arable land, about 900 million hectares. It estimates sub-Saharan Africa will account for over 80% of the increase in land under cultivation by 2050. Africa should not just feed itself and stop spending close to or more than $100 billion on food imports if we look at UNCTAD estimates. We should be helping to feed the world. The continent has the basis for full agro-industrial development. Third, the continent is the resource hub of the future. Africa holds an estimated 30% of minerals critical for the low-carbon energy transition, making it central to efforts to manufacture and deploy renewable energy technologies at scale. Africa accounts for nearly half of global cobalt and manganese reserves and is also home to substantial amounts of natural graphite, copper, nickel, and lithium. But as Nigerian economists, we know all too well that exporting raw commodities is not a promising path to prosperity or large-scale job creation. While we should learn from the example of countries like Botswana that have translated natural resources into broad-based growth, we know that harnessing the full development potential of critical minerals will require African countries to advance productive linkages and value addition, processing, and manufacturing. We should also learn from Botswana's experience now that natural resources are not forever, like diamonds are not forever, since lab-grown diamonds are now increasingly being made and becoming more available. We should add value to the natural resources we have now before scientists start manufacturing those in the lab too. On value addition to our natural resources, we also have a promising story to tell. The continent's abundant solar and wind energy potential opens the door to seize green comparative advantages. You remember Ricardo's insight. Individuals and countries reap economic gains by specializing in what they are relatively good at. The green variation of this is that if countries specialize in economic activities they are relatively green at, the world reaps environmental benefits. We can envision regional value chains in which renewable energy and green hydrogen fuel the processing of critical minerals on the continent. Abundant and cheap green energy would make Africa an attractive location for many kinds of energy-intensive goods and services. And what makes me really excited about all these things is that this is no optimistic projection based on unrealized potential. The future I'm describing is here already. Some of it is being reported on CNN. The problem is that it's not nearly at the scale we need. Despite the shocks and setbacks of recent years, the growth stories are there. According to the African Development Bank, 11 of the world's 20 fastest growing economies in 2024 were African, among them Ethiopia, Rwanda, Cote d'Ivoire, Senegal, and Guinea. Over the past decade, Ethiopia averaged 7.6% growth per year. Rwanda 6.9% and Cote d'Ivoire 6%. These countries and their leaders are showing the continent we can grow and develop. FDI inflows into sub-Saharan Africa last year increased by 10% to $46 billion according to UNCTAD. Still, too small for a continent of 1.4 billion people. Africans are investing in Africa. We see Nigerian and South African companies, our own Dangote, UBA, Access Bank, Zenith. We see ShopRite, MTN from South Africa, and I could go on, present in countries like Cote d'Ivoire, Ghana, Benin, and Cameroon. Africa investing in Africa is exciting. We could also do more here by tapping Africa's existing pools of capital for investment, like the over $250 billion in pension funds from South Africa, from Nigeria, from Kenya, or the growing number of sovereign wealth funds we have. I keep pointing out at every opportunity I have that the continent does have its own capital that we can draw on, and we should not be investing that capital outside, but increasingly inside the continent. On the manufacturing front, Ethiopia has been attracting investment in labor-intensive manufacturing. Auto sectors in Morocco and South Africa are exporting more than half of their production, even if they're experiencing difficulties now. We are also seeing the emergence of so-called industries without smokestacks, sectors that share many of manufacturing's growth-enhancing and job-creating properties, like being tradable, employing low and mid-skilled labor, decent value added per worker, and scope for productivity growth and agglomeration effects. Horticulture and agro-industry are two examples. Kenya's cut flower industry has become a major exporter and is employing directly or indirectly 150,000 people, many of them women. Ethiopia, a rising horticulture exporter, has partnered with Kenya on meeting EU health and safety requirements and has leveraged the transit logistics enabled by Ethiopian Airlines. Packaging and processing are helping producers capture more value. Public-private partnerships are working to boost agro-processing, reduce post-harvest losses, and strengthen farm-to-market value chains. Agri-tech companies like Ghana's Farmerline and Nigeria's Thrive Agric are using digital platforms to connect farmers to data, training, and credit, leading to higher yields and better market connections. Another example is Africa's vibrant tech ecosystem. In fintech and particularly mobile money, the continent is a global leader. The GSM Association reports the continent has more mobile money accounts than any other region, and that the sector in 2023 added $190 billion to sub-Saharan Africa's GDP. Innovative cross-border mobile payment systems are facilitating trade by making it easier for a trader in Cote d'Ivoire to pay a supplier in Senegal or a Kenyan entrepreneur to receive e-commerce payments from across the continent. Billion-dollar-plus unicorns like Nigeria's MoneyPoint and Africa's Time Bank are demonstrating what's possible. Yet another thriving sector is our cultural and creative industries. African movies, fashion, music, books, and food are taking the world by storm and creating a lot of jobs for young people in the process. Nollywood employs an estimated 300,000 people and contributes 2% of Nigeria's GDP. And this is probably nowhere close to a ceiling. According to the U.S. Bureau of Economic Analysis, arts and cultural value added make up 7.5% of California's GDP in 2023. We can reach that in Nigeria. We are seeing progress on the resource front as well. Critical mineral projects are coming online, from a lithium mine in Mali to a Sino-Moroccan venture near Casablanca that started producing EV battery components in June. It used to take a month to drive copper cathodes from the Congolese copper belt to the Angolan port of Lobito. A first shipment by rail last year took just 6 days. We even see moves to seize the green comparative advantage I talked about. Kenya has attracted $1 billion investment to build a geothermal-powered data center, and plans are underway to provide solar and battery power to a major copper mining complex in DRC. So we can see the future we want, but we still have a long way to go to sustain the kind of GDP growth, more than 5% a year, year after year that we need. We need to attract more investment, build more value chains, and create more and better jobs for our young people. The obstacles we face are serious. That does not mean they're insurmountable, though. Let me talk about the obstacles a bit. On the macroeconomic front, tighter global financial conditions, aid cuts, and trade uncertainty are not helping. Afreximbank warned last year that more than half of African countries were at high risk of already in debt distress. According to IMF data, Sub-Saharan Africa's external public debt nearly tripled from $292 billion in 2010 to $823 billion in 2024. The cost of servicing these debts as a share of GDP has nearly doubled from 3.4% in 2010 to 6.5% in 2024, pushing it above government spending on priorities like health or education. Especially with aid in decline, African governments need to mobilize domestic resources more effectively. The bad news is that tax revenues right now are low. The good news is that there's enormous room for improvement. According to the OECD, the average tax to GDP ratio in 2022 for 36 African countries was 16%, a bit higher than its level a decade earlier, but still lower than the 19% in Asia and the Pacific, the 21.5% in Latin America and the Caribbean, or the 34% in OECD countries. The IMF estimates that improved tax design and stronger institutions could raise tax to GDP ratios in low-income economies by up to 6.7 percentage points. The right reforms can yield benefits quickly. Changes in tax administration and VAT application helped Togo lift its tax to GDP ratio from 14% to 17% between 2013 and 2022. Narrowing the gap between Nigeria's tax take and the continental average would make up for any loss of ODA. But this is a thorny issue, as we know, because higher taxes are part of a social contract. Governments must be seen to be delivering better services in a fair and cost-effective manner for the public to accept greater taxation. African governments also need to strike better resource contracts and enforce them more effectively. When I was Minister of Finance, we found that some oil and gas companies were not complying with the agreements that they signed with us. Through the oil and gas unit that we set up in the Ministry of Finance, headed by Dr. Bright Okogu then, we were able to track an additional $1.3 billion in revenue that the companies owed us and had not paid. So implementing contracts and keeping track of them is very important if we are to generate more of our own resources. Another factor holding back the continent's growth prospects are some of the world's highest trade costs. WTO economists estimate that Africa's trade costs for agricultural goods are 16% higher than the average for the rest of the world, and 19% higher than the average for high-income countries. For manufactured products, the figures rise to 37% and 47% respectively. Nigeria's trade costs are even higher than the African average, 7% higher for agricultural goods and 4% for manufactured goods. On top of that, intra-regional trade costs in Africa are 20% more than those for trade with external partners. This is not a recipe for global competitiveness or for the formation of regional value chains. In light of costs like these, it is not surprising that only 15% of African countries' trade is with each other, compared to roughly 60% in Europe. But as with the tax take levels, we should think of weak numbers, not as an impediment, but as an opportunity to improve. We need to accelerate the implementation of the African Continental Free Trade Area. That needs to move faster. Reforms to fully implement the WTO's Trade Facilitation Agreement would help drive down trade costs as well. And we need to combine this with stepped-up efforts to improve transport corridors and logistics infrastructure. Soft infrastructure matters too. Afreximbank's Pan-African Payment and Settlement System, PAPSS, promises to complement innovations in the fintech space by reducing transaction costs and accelerating cross-border trade. WTO research shows that improving access to trade finance would also help bolster trade flows. So in summary, friends and colleagues, ladies and gentlemen, rethinking Africa's development is neither a utopian exercise nor an empty slogan. What I have set out here in terms of the concrete opportunities before us, as well as the obstacles that we can overcome, shows that the continent has what it takes to move from potential to renewed and faster growth, and beyond growth to social development. We of course need leadership and governance with the appropriate courage, transparency, and drive to push this forward. Some leaders have realized that the world has changed and that they and their countries must also change to seize emerging opportunities. Others are stuck in old paradigms and will surely be left behind. On the part of the WTO, we are trying to help with de-risking investment through our Investment Facilitation for Development Agreement, with support on digital infrastructure and connectivity to build on the bright spots I described earlier, and with empowering women through our Women Exporters in the Digital Economy Wide Fund. Last month in Abuja, the WTO Secretariat and our partner, the International Trade Center, announced the fund's first cohort of 146 beneficiaries in Nigeria. Selected from among over 67,000 applicants, they will receive targeted support of $5,000 to $30,000 in direct grants to their accounts, as well as training for 12 to 18 months to boost their digital capabilities, boost their financial readiness and export potential. Excellencies, ladies and gentlemen, dear members of the Nigerian Economic Society, let me now conclude. Africa has what the world needs. Africans have shown that they can seize the opportunities. My question, ladies and gentlemen, will the continent's leadership and its followership, meaning all of us, have the courage to pursue and scale these opportunities? Will we write the story we want and rethink our development? From my viewpoint, the answer is yes. And by the way, dear friends, we have no choice. Thank you.